Gold's ominous warning. A deep dive with historical context police Garlight. The recent historic surge in the price of gold is more than just a financial headline. It is a profound and deafening warning from the oldest form of money on Earth. Gold's price action signals a crisis of confidence in global financial systems, currencies, and economic stability. This revised analysis deeply explores the key points, integrating real-life historical incidents to contextualize the current alarm. Chart increasing the shattered record. An unprecedented price explosion as a no-confidence vote. The most immediate evidence is the price itself, which has rocketed to an all-time high of over $4,000 per ounce. This level, unimaginable just a few years prior, is being driven by panic, not prosperity. This is the oldest money sending a message. We don't trust the new money. The scale of the move and historical example. Gold's most legendary rise occurred during the late 1970s. As the U.S. faced a period of stagflation, high inflation, and low growth, following the end of the gold standard, Bretton Woods system, in 1971, the price of gold soared from around $100 to a nominal peak of $850 per ounce in January 1980. This explosion was a direct response to the loss of confidence in the U.S. dollar's purchasing power and the failure of government policy to control inflation. The current surge is its modern parallel, once again confirming gold's role as the ultimate anti-fiat currency. A mourning metal. Every spike is a vote of no confidence. Professor Pasquariello's warning about exploding prices is validated by history. When confidence in financial institutions dies, gold mourns by rising. Globe showing Europe-Africa gold's enduring importance. The monetary and economic foundation for every country's shield. Gold's importance to national economies and monetary systems extends far beyond a simple investment. It is a unique asset that forms a geopolitical and financial bedrock for countries, especially during times of crisis. The concept of no counterparty risk. Unlike bonds or foreign currency, physical gold is not anyone else's promise to pay. For a central bank, holding gold means possessing a universally accepted asset that is immune to national defaults, political sanctions, or the solvency of any single bank. This makes it the most secure ultimate reserve asset. The reserve asset and crisis buffer. The Great Depression example gold acts as a crucial buffer. During the economic collapse of the 1930s, the Great Depression, the U.S. government, by raising the fixed price of gold from $20.67 to $35 per ounce in 1934, effectively devalued the dollar and boosted the dollar value of its gold reserves. This maneuver increased the size of the monetary base, allowing the government to inject necessary liquidity into the economy and help finance the New Deal programs. Manipulating gold reserves was a primary tool used to fight deflation and restart the economy. A hedge against currency debasement. Post-COVID, stimulus gold scarcity ensures its value against fiat currency debasement. The accelerated central bank buying over the past 3 years is a direct response to the massive quantitative easing, money printing, implemented globally. Countries like China and India are diversifying their reserves away from the highly indebted U.S. dollar and into gold to protect their sovereign wealth from the inflationary consequences of global money printing and the resulting loss of purchasing power. Bank desperation and the printing press paradox. Central banks buying gold. The most compelling evidence of systemic risk comes from the very institutions tasked with maintaining financial stability, central banks. Record hoarding and historical example. Central banks are buying gold at record levels, accumulating over 1,000 tons in each of the past 3 years. This mirrors action taken during periods of heightened geopolitical risk and monetary instability. The freezing of Russia's foreign currency reserves by Western nations in 2022 was a crucial turning point. This demonstrated to other nations that dollar-denominated reserves are subject to political seizure, spurring countries like China, India, and Turkey to view gold as a politically neutral reserve and the last lifeboat on a sinking ship. The paradox of the printer. The people who control the printing presses are heavily acquiring the one thing they cannot print. This signals they are preparing for a future where trust in their own printed currency is fundamentally compromised. Chart decreasing the cracks in the king. Historical decline of the U.S. dollar. Gold's rise is inversely proportional to the deterioration of the U.S. dollar's dominance, historically considered the world's reserve currency. Loss of global reserve share and historical example. The dollar's share of global reserve has fallen to its lowest level since 1994, a 30-year decline. The most significant historical marker of the dollar's vulnerability was the Nixon shock in 1971, when President Nixon completely ended the convertibility of the U.S. dollar to gold. This action decoupled the dollar from its tether, transforming gold from a fixed asset to a floating one that could rise with inflation and currency devaluation. The dollar's current rapid decline, losing over 11% in the first half of the year, is the aftermath of 1971, where decades of debt creation are accelerating the currency's erosion. The inverse correlation. When the dollar weakens, it takes more dollars to buy an ounce of gold, forcing the price up. This current surge is gold screaming about the dollar's vulnerability. Police scarlight economic distress, the shadow of recession and falsified job numbers. The timing of gold's surge is ominous because it coincides with clear, undeniable evidence of an economy under severe stress, masked by official statistics. Recession probability and historical example. With recession models climbing toward 50%, the market is on edge. During the Great Recession of 2008 to 2009, as Lehman Brothers collapsed and the financial system faced total shutdown, gold prices surged from around $730 per ounce in October 2008 to over $1,000 by early 2009. The price rise reflected a flight from bank counterparty risk and systemic panic, exactly what a 48% recession probability model suggests is looming now. The labor market lie. The revision down of nearly 1 million jobs is evidence of an economy running on statistical fumes. This lack of verifiable employment mirrors the conditions before major downturns where official optimism is belied by underlying economic fragility. Chart decreasing the technical trap, a bubble forming in real time. Technical analysis suggests the current gold surge may itself be a symptom of panic, creating a speculative bubble that could burst before the broader crash. Mirroring past crashes and historical example. Analysts warn the current chart patterns look eerily similar to market tops preceding major crashes. The ultimate historical gold crash occurred after the 1980 peak. Gold hit $850 per ounce in January 1980, driven by inflation and geopolitical turmoil. However, as the Federal Reserve, under Chairman Paul Volcker, aggressively raised interest rates to historic highs, above 20%, to kill inflation, the gold bubble burst. The price crashed dramatically over the following years, signaling the end of that panic cycle. The boom-bust warning. The warning about the boom cycle turning into a bust period sooner than investors expect highlights the technical trap. When everyone rushes for the same asset at the same time, the parabola price action becomes unstable. Conclusion: the mathematical certainty of a system under stress. The combined signal from record gold prices, central bank hoarding, dollar erosion, recession warnings, and technical instability present a mathematical certainty of a financial system that has borrowed and printed too much to sustain its obligations. Gold isn't just hitting record highs. It's screaming a warning based on the lessons of every empire and currency collapse. Would you like a list of actionable steps to take in a portfolio to hedge against the risks indicated by the current gold market and economic outlook?